Welcome back. I'm Pierre Daillie, and this is Raise Your Average. Here with me today is my co-host, Mike Philbrick, CEO at Resolve Asset Management Global, Jeffrey Sherman, Deputy CIO and Portfolio Manager at DoubleLine Capital is here. Jeffrey, welcome back.
Yeah, thanks for coming. And raising your average. I took your advice last time, and as Mike and I were discussing at the onset, we're trying to raise my room rating average here too.
Oh, yeah.
So since the last time, I think I'm trying to do a little bit better, but we'll see. We'll see what the feedback is. I'm not convinced. So
You're crushing it. You got a big picture. You got orchids. It's the Shermanator in his room. You're going to get at least, I'm thinking you're going to get, I would say at least into the high eights, low nines with that.
all right, that's all we can hope for. That's at least a B, right? That's raising our average. So.
Exactly. And Room Raider, get on it. Tell us what it is.
Jeffrey, did you take that? Did you take that photo? Is that a photo that you've taken?
No, I went the cheap route, or maybe it's more expensive route, but I bought it. So, that's one of those things where I don't have that photographic eye. I'm not the artistic one. I'm the other side of the brain. I can't remember which side it is, but way too analytical to get into art.
Well, now with the Mid Journey and AIs, it is interesting that you can be quite technical in orientation and pump out some pretty cool art.
Yeah, I think I know what I like when I see it, but I'm never the one that could create it, right? So
Yeah.
I'm not the one that goes in the art museum and says, hey, I could have done that, because I always go, there's no way in hell I would have ever came up with that.
Yeah.
So I appreciate what I appreciate, and I guess that's what you're always told. That's what art is, right? So
Yep.
Well, you can use it to create unlimited, NFTs and dilute the market.
yeah, well, I did. Someone sent to me the other day that they've created a new mapping, like a tile mapping, which is non-repetitive, and so it's been this math problem that they've been trying to solve for many decades, of trying to have a non-repetitive tile mapping with only using one object, and they were able to finally do that. And so again, not into the topology and know all of that, but I thought that was pretty cool, and so I think that will help AI create some new things as well.
Well, Jeffrey, it's great to see you again, and honored to have you on again and catch up with you.
Yeah.
We're really stoked to have you back and for the chance to have this conversation with you.
Yeah, Pierre, have you been brushing up on your California speak with stoked?
I did. That was deliberate. That was deliberate for you, for all of you in Santa Monica.
Right. Dude, we appreciate it. Yeah.
Yeah. Well, Jeffrey, it's been quite a quarter and definitely quite the year. What's new in DoubleLine land?
Well, I mean, it's the markets always throw you curveballs, so we're always trying to do that. But we've continued to innovate. We have increased our footprint since the last time we talked in the ETF space, and so we'd sub-advised three ETFs through the Spider brand with State Street, and last year we launched our own two new ETFs, and so one on the equity side, one on the bond side. And actually last Friday, we launched two new ETFs as well. They'll list on the exchange tomorrow. So by the time this hits out in the system, we'll actually have 4 ETFs up and running. So we continue to innovate. Yeah, we continue to listen to the demand from our clientele and be able to deliver in the vehicle of choice that people are looking for. And we've heard a lot over the years to the ETF wrapper. And so we're happy to be able to provide our clients some exposures to some different strategies now. These are 2 newer strategies that we're launching in the ETF wrapper.
Well, congratulations. I'm just curious. Why would you want to do that?
Well, they always say innovation is the lifeblood, right, of the business. But it's things that we thought there was a hole in the marketplace for, and so one of them will be a residential mortgage-backed fund, purely on that side, focused on both agency and non-agency. And so we think from our expertise in that space, just focusing only on the agency side limits the scope of that. And so bringing our expertise there, we thought, is something that's really kind of missing in the marketplace right now, having that flexibility to use both of those sectors of the residential market and further expand it outside of just what's in the index. And then secondly, the one that made people would scratch their head and say is a little more controversial, but we really much love the concept, is something focused on commercial real estate. And so, with all the headline risk and everything out there, it's created some really good opportunities there. But our team has ran very high quality, low interest rate sensitive or low duration parts of the market in our low duration strategy. And just looking at that isn't in the marketplace today. And so we think with our risk controlled approach, the underwriting that our team does in the commercial real estate place, that this is something that's ripe for an opportunity set. And in today's market, it's one of the few asset classes, I would say, that is truly priced for a recession, priced for bad things to happen. And so if you know what you're doing in the space, and I have a lot of confidence in our real estate team there, we think there's a great opportunity there. And so to bring that to an ETF wrapper, we're very excited about. And so as I said, I think some folks would scratch their head, what are you doing? You're jumping right into the fire. But this is a part of the market that we think is extremely attractive. And so we have an evergreen solution for that. And so we're bringing that out as well. So we're excited, so the team is fired up, put money to work today. It's very, very interesting. So it's good times.
Awesome. Before we get started, I do want to introduce you just in case there are still some folks who don't know you. Jeffrey Sherman, DoubleLine's Deputy Chief Investment Officer, masterfully leads the investment management subcommittee and shines as the lead portfolio manager for multi-sector and derivatives-based strategies. A key member of DoubleLine's executive management and fixed income asset allocation committee, his influence is far-reaching. You can catch him on the Sherman Show podcast, where he interviews top-tier guests and shares DoubleLine's latest insights. Named one of 10 fund managers to watch by Money Management Executive in 2018, Jeffrey Sherman's expertise is undeniable. Previously a senior vice president at Trust Company of the West, he honed his skills in fixed income and real asset portfolios. A devoted educator, Jeffrey taught statistics, mathematics, and quantitative methods for CFA Level 1 candidates. Armed with a Bachelor of Science in Applied Mathematics and a Master of Science in Financial Engineering and a CFA charter, Jeffrey Sherman is a financial powerhouse. So please stand by, and while you are, please like us, follow us, and above all, subscribe.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of AdvisorAnalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
So Jeffrey, what the heck is going on in the bond market? We had SVB, Credit Suisse, the banking crisis. What's your take on all of that?
Well, don't blame the bond market for that. We get blamed for a lot of things out there. That the bond market was crushing, financial markets last year. But I'm not going to take any blame on the bond market for SVB, Credit Suisse, or the likes. And so, it's been a wild ride once again in the rates market as well as in credit in the first quarter. If you think about it, we started the year with a big rally in rates, right? January was one of the best Januaries on record for the bond market out there. And a lot of it came from, we saw a materialization of economic slowdown at the very beginning of the month. And so, looking back, I think what the market was responding to, or at least rates were responding to in early January, were two key reports. And one of them was the ISM services data. There was a big collapse in that data set. And this is something that, when you get the contraction in ISM services, it typically puts you on alert. If you get it consistently, a contraction, it should put you mired in some form of recession. And we saw this, that was one of the few data prints that was the holdout late last year, where people are talking about a recession. If you think back in the first two quarters in 2022, there was all of this, there was a contraction in GDP. The debate was out whether in a recession or not. I never really thought we were, because the employment was strong, the retail consumer was there, and again, services was there. And so what you've seen was that you saw that collapse. But if you really look back in the data, the other data point that came in, which is a big shocker, was we had a contraction in retail sales in December. And you historically don't really see that. Really, December tends to be a positive month. There's the holiday spin and the likes. And as you start to dig through it a little bit and you look back, you see the aberrations where there was accelerated spending in October and November. And, again, one narrative that we kind of developed about that is, potentially what happened is that people that experienced from 2021 during the holiday season where the supply chain issues weren't able to source things. So maybe people consumed a little bit earlier. But again, I try to get caught up in narratives, but again, trying to really tease out what's going on in the data. But then by the time we got to February, all of a sudden there's the rebound in services, the spending comes back, retail sales are there again. Yes, credit cards went up a little bit. We still continue to see some income growth. So all of a sudden the market's like, wait a second, potentially that December data was the aberration. It was not the harbinger of negativity. And so all of a sudden, if you were chasing that market in January, then you got whipsawed the next month and you got the reversal, you got the Fed talking about hiking more, upping their kind of dot plots and the like. And so, okay, now you're saying, okay, we're back on track. The Fed's kind of back in play. And then, Pierre, we ended up getting the SVB situation, right? You got Signature Bank as well, which a lot of people don't talk about, but that was in the middle of that as well. And so all of a sudden, you had this fear of a banking crisis. And, the banking crisis, I'm going to still call it a crisis because it is a crisis. And, what we've seen thus far is a heavy response from the Fed. They provided liquidity. They provide facilities to help kind of stabilize that market. But it's a banking crisis and it's not reminiscent of the financial crisis we saw in '08. And the difference here is the banks, now we haven't really distilled what's in their loan portfolios, right? What they've actually lent out into the market, but their asset portfolios are easily analyzable. And so unlike in '08, where we didn't know what the value of the subprime mortgages were, we didn't know what the CDOs were, we didn't know all the exposures there. They were at the larger banks, which are harder to distill. This is pretty obvious. I mean, my boss said it recently is that, all you got to do is hire an intern at the Fed. They can push the refresh on the Bloomberg spreadsheet to get the prices every day. They know what the value of that is. And so, this was a crisis of confidence. Look, it was a bad situation because, SVB was connected to the VC industry. And there were so many, it was a well-connected area. Everybody knew everybody. And so it was one of those quintessential bank runs. And, look, the value of these assets, it is depressed because of the Fed's interest rate policy. Rates are simply higher. But these assets are practically government guaranteed. And so it's a mark-to-market issue, not an impairment of capital issue. And as investors, there's a huge distinction there. And so, what we saw is, really a reset of pricing once again. Rates are kind of muddling along at these levels again. We had, some overshooting a little bit to the downside. But what's amazing about all this is that we stayed in this trading range, still throughout March, even with all of that, because we shot to the upper end of the range. And so I think right now, what we're reading from the bond market is what are the implications of this? And so, we've seen equities rally. We can talk about that in a bit. We've seen a lot of this risk come back into the market, thinking, implying, let's say, that things are all back on track and everything's rosy. And I'm a bit more cautious on that because, the old saying is that there's not ever only one cockroach, out there, right? There tends to be more. And I think that this is an endemic problem in some of this banking area. And so I think the ramifications are very profound here. And I think what this is going to do is lead to a credit contraction. And I can expand upon that more, but you gave me a very basic question. I jumped very deep in the weeds very quickly. So let me pause there and see if there's anything else you want to talk about within that.
Yeah, I guess it's a little premature. I think I would agree with you that it's premature to think that the banking crisis is resolved. There's obviously a lot to look forward to in terms of the outlook at the banks. And, one of those things is the higher cost of deposits, right?
Yeah.
And margin compression, margins compression on bank earnings as they try to meet with the demand from their depositors.
Yeah,
and people,
that has significant ramifications because it's not just the NIM, right? The net interest margin compression we're talking about. They've got to change their business model here, right? Their business model was predicated on essentially not giving you interest, right? okay, maybe they were, sexy relative to the big banks, and they were giving you 50 basis points on your savings. But if you look at the big banks, a lot of them still today give you 1 basis point on a savings account. And what a lot of people have woke up and realized is, wait a second, I can open an account at Treasury Direct, right? You can buy T-bills directly from the government, set up an account with them. They will put them in your account for you. It does not take a level of sophistication, and you can get 5% today, right? So wait a second, I can get 500 times the earnings rate at the bank. The banks always sell as an X multiple of one another. And so what you're seeing here is that I believe what it's done is it's woke up the population. And all of a sudden, people are realizing that, wait a second, the bank isn't paying me what interest rates are out there. And so it's that cost of funding goes up. And so if you want to protect your deposit base today, what you need to do is move that rate up meaningfully. It means you need to sell them CDs. CDs at least lock them up, right? Some of them are FDIC insured and the like, so consult your tax advisor and all that stuff. But at the end of the day, what that means is that if they're going to extend a loan out to somebody, it's got to cover their funding rate, right? So it's not just margin compression. It's saying that the cost of credit needs to go up meaningfully. And why that's important, well, first of all, you could say, okay, well, that's great, Jeff, but I look at, investment-grade corporate bond spreads. I look at high-yield spreads, and they haven't moved meaningfully during this. Yes, they've moved up, but they haven't moved commensurate with that type of, differential I'm talking about on deposit rates. But, these are different corporations, right? They borrow in the bond market. They don't borrow from a local base. And so, the thing about the regional banks is that they service something like almost half of all the small business loans in America. Well, we always talk about small business being the backbone of America. And it is. If you want to look at where job creation is, this is really where it's settled. And so what this means is that, likely, the funding, the cost of loans is going to go up meaningfully. So what does this mean to your local restaurant, your local, art store? So if we're talking about art, right, that maybe wants to expand a little bit, it's going to be extremely expensive now, and they're going to feel the effects of all these rate hikes that have been pent up into the system. And so my concern is that this creates a credit contraction. One is that the cost is going to go up meaningfully, but secondly, what is the propensity for these banks to want to go out today and originate a long-term loan, right? I mean, maybe you want to do a 6-month financing, maybe that, but they're going to be nervous about their depositor base. And so that's the thing that really is kind of unnerving about this, is that I think there are knock-on effects of all of this, and those are things that haven't materialized yet, and we haven't seen.
Well, I think they may be actually materializing, because if you look at, so this is pretty classic, right? First, the Fed hikes rates. Next, domestic banks tend to tighten their lending standards. We've seen a flight of cash out of those systems. Now, keep in mind, you go back to 2000, you got 3% at a bank, and you got 5 or 6% on a T-bill or on a government bond. This gap has existed traditionally. The challenge is today, everyone is incredibly fintech savvy. And as you've pointed out, Jeff, you can go and easily get access to all of these places where you have a superior guarantee on large sums of money.
In one day.
In one day.
Right.
And those regional banks have seen these funds flood out of their system. That leaves less money to lend.
Yeah.
Period. So now,
and that's on a backdrop of the liquidity, liquidity mismatch as well, right? That
further tightening liquidity conditions then are leading to, we're already seeing this, that you see the loans and leases that are being created and provided have started to contract. And Powell did comment on that in his comments, that I've got to have an eye on this because there is an impact that comes to the economy from this. So all of this kind of waterfalls, this is pretty much due course here. The funny thing is, I mean, with SVB, I'm wondering why they didn't just close their online bank. Like, it's kind of a funny thing that they left it open. You can just turn it off, which
you can do that, but you're probably not going to be in business very long, right?
Maybe not. Well, it would have paused for a moment. It's interesting that the 3 banks that were allowed to fail have something in common: Silvergate, Signature, and SVB, all
start with an S.
Yeah, they all start with an S, right? And they also have lots of lending into high tech and fintech type businesses, Signature and Silvergate, particularly crypto related. So it's interesting that these three were allowed to go through the failure process. Having said that,
On that point,
And the
there,
backdrop, the other backdrop, I just wanted to add to what you both said is that the held to maturity paper losses, unrealized losses on held to maturity assets is also putting a lot of pressure as well, right? I mean, I think people maybe don't realize that when they look at banks, the deposits are actually the liabilities, and the loans and the investments are the assets, right? And when your
they
investments
don't
are
mark the loans to market. They only mark the asset portfolio to market, which is
well, and
another
if it's held to
interesting
maturity,
only on the
held to
AFS.
maturity, if
twist.
it's
I'm
held
talking
to
about the
maturity,
loans that they
don't
make.
mark
They don't
either.
have to on
Yeah.
the HTM unless they actually do one, they do all, which is all kind of weird and perverse.
But it's
unintended
backwards, right? It's the
consequences.
opposite of what people think. People think that, SVB had $200 billion in assets or more, and that was ample liquidity, but it's not. That's ample liability. It's not ample liquidity.
Right, because you have to meet the depositor's request if you do so. But coming back to Mike's point too on these three being very related, I think that's part of the reason you saw the run. You're talking about a tight-knit community, one that uses, I don't know what technology, Reddit, whatever they use to chat these days, where they get together and they know each other, right?
Yeah.
And this is what kind of extended out to First Republic in my viewpoint as well. First Republic, we in California think of as a high quality bank, high touch service, the old school white shoe. They do a lot of lending, private, customized stuff to wealthy people. And guess what? Wealthy people talk to each other, right? That's what their circles together. And so some of that money went over there, then it left very quickly as well. And so I think what you're seeing here is it's like this psychological behavior. And, it's someone saying, well, if I think there's going to be a run on the bank, Mike and Pierre, am I going to call you? I may, but after I move my money out. And I'm going to tell you why I did it, right? I'm going to get my money saved, and I'm going to call you guys and tell you, man, you guys got to get your money out of there. Here's the problem at this bank. And so I think that's the elements you saw. And I think, some of it is why the FDIC stepped in. They did create moral hazard here. If we're going to talk free markets and everything, you got to put on your big boy pants. If you're going to do this stuff, if you're going to keep more than $250,000 at the bank, you got to make sure you have a sweep account, right? It doesn't cost anything. Like, you can get a sweep account that sweeps into government money market, right? To protect yourself. And so I think people are going to learn more about the banking system in this and how this applies. But, look, they did create moral hazard because Yellen one day, during the press conference, she's saying, we're not going to guarantee it. Powell's saying they're going to guarantee it. They're just causing mixed signals because they don't want to guarantee it. But they also need to instill confidence, right? And so, when Yellen was testifying, I think it was the congressman from Arkansas was asking, or maybe it's Oklahoma, I can't recall, but he's saying, well, if my banks fail in my region, are you going to do that? No, they're not protected. Well, if they fail, they're protected. And it's like, so you create the moral hazard by doing that. And so, look, did we need to do it? I think it was probably the right thing to do to guarantee those deposits in the short term, because you would have had a classic run. I think every bank would have experienced this with assets above 250 from any client. And so, again, that's the thing. The market needs to work. You got to play by the rules, but this is one of those where, I think the Fed and the FDIC and Treasury, they're flying by the seat of their pants here. They didn't want to have a banking failure in the middle of this. But Mike, lastly, to your point, the Fed hiking, contracting, tightening conditions, that's the whole plan. They hike until something breaks. And I think it's pretty fair to say they broke something last month. They're trying to fix it with the tools they have, but they're also hiking rates still. They're removing liquidity via QT because they have to shrink their balance sheet in their viewpoint, but they're pumping liquidity that offsets more than that in the market. So once they stop pumping that liquidity in, we go back to tighter conditions again. Now with a tighter system as well. And so to us, this has put the recession watch. It's moved it up meaningfully. This looks like we probably have a meaningful contraction at some point, by summer to fall of this year. And again, it's gonna rely on the response mechanism and what that catalyst is to get us out of that. And right now, I think this is the plan of the Fed. They wanted to crush some of the housing market. It was on fire. It was creating this speculative influx because of the wealth effect. And so all the stuff they did in the last cycle, people realized that it got on steroids this time because of the amount of stimulus. And now they're trying to fight inflation. And so, look, at some point, this stuff becomes deflationary, right? You just don't have the impulse. You don't have the credit impulse out there. And therefore, that means we're going to have a slowdown. And so, I think the implications for investors right now is that don't get caught up in the panacea. This is not the time to exceed your risk taking. It's not the time to increase it. It's the time to reassess, look where you're at, and make sure that you're comfortable with the amount of risk you have. And our point for the last, even before this crisis in January was let's sell on strength. Things that are rallying, let's try to monetize some of this, and let's try to build up a better defensive portfolio. And, we've been doing that for the last 6 to 8 months. And so when SVB came, a lot of people want to interview us and ask, what are you doing? It's like, we haven't really made any meaningful moves here. Portfolio's fine. We had bought duration coming into this year. We continue to extend out a little bit in January. And so we were comfortable with it. And, look, you never want to make a knee-jerk reaction here. And so, we've been reassessing now that things look a little calmer. And the consensus around the table as we had these discussions, that look, we have a lot of banking analysts that really understand this stuff very well, way beyond the scope of what I do. And, it's saying like, look, this is a problem. And look, SVB had been written about for months, right?
Yeah.
So all available for months before. Sort of like COVID almost.
But then
it was widely known for a time before it mattered, and then all of a sudden,
but this is a failure of the Fed. This is a failure of the Fed.
I think we agree. I think that's an agreement, a hard agreement there. So what are the implications as we move on? So now we have tighter financial conditions. All of a sudden, now you have the Saudis come out and say, "Hey, we're going to cut production," right? So now we've got another inflation push there. If China's reopening domestically, so domestically, China's economy has reopened, whether you look at China's stats or sort of look at airline stats in China to see how they're refiring up the internal domestic economy. At the same time, we still got pretty tight labor. We've got this urge to, sort of have domestic energy independence. We want to nearshore or duplicate or shore up supply chains so that we have a higher likelihood of them actually lasting rather than the cheap and cheerful just in time. It's no, we want resilient, redundant supply chain. All of this does not paint a very good backdrop for which the Fed will be able to make decisions. The previous 40 years prior to 2021 was easy. I mean, you had this deflationary backdrop. Inflation wasn't a concern. So I too am concerned about the equity side of the equation. The equities seem to be pricing in the immaculate recession, if you will. So what are your thoughts there? So we keep being conservative. How are people supposed to navigate this? What do you think are some of the shoes that could drop along the way?
I thought about all this year was, if you want a risk to this kind of inflation side, and it was predicated on the China reopening, not really an OPEC thesis, was that you put some allocation to commodities, right? If we're going to have the reopening, if we get to the stage where you're going to get consumption back, and remember, this is a highly dependent economy on oil over there in China as well, right? If you're going to get the production restocking, it's good for industrial metals as well. And so to me, when people are saying, what about the inflation tips and the like, I'm like, don't look at the bond market for this, right? Use the bond market for your deflation, for your defense here, but use a commodity allocation to do that. And I think, that's kind of what we're seeing right now. And when I listen to you ramble off all of those metrics, Mike, and don't take offense by rambling, you're just saying them back to back. And so ultimately what I hear in there is that it sounds like there's a demand for commodities, right? And, I think that's also could be one of the potentially saving graces if you think about it. If the Chinese economy and the Chinese themselves respond like the rest of the world did post-COVID, they're going to travel, right? They're going to consume the oil, they're going to jet fuel, but they're going to come to our country too. They're going to spend money here. So potentially that's a little bit of a saving grace here. But if I look at kind of, you think about that small business side, they provide a lot of service jobs. And that's where you've seen the strength in the labor market. And so I know a lot of punditry will come out and say, well, those are lower paying jobs. It's not as good. Look at all the tech layoffs and look at the finance layoffs that we've seen out there. And I guess now we have McDonald's announcing layoffs today, right? At the corporate headquarters. I always wonder how many people work at that corporate headquarters of McDonald's, but it's supposedly a really cool facility outside of Chicago. But anyway, not to digress, but what you found, what I kind of look at in that service data is that this is the area that the jobs didn't come back yet, right? Because there was the uncertainty, there was the starting and restarting of the economy, there was opening, is there a mask mandate, what do we do? And, the different parts of the country attacked it differently. And so, I think there was some hesitancy, for those jobs to come back. And look, I went to someone's wedding this weekend and stayed at a hotel, and it's like, if you want service, you have to request it, okay, that's fine, but it's just like you can see here that the staffing is different. And so I think what we see in this resiliency is that it was a handoff to this other part of the market that was slower to hire. And some of the tech jobs they overhired and the like, because it was like, this post-COVID world forever. We're never going back to offices. We're never doing that. So I think that you had this push and pull in the labor market that I'm concerned now because of what we talked about on the banking side and small businesses not having access to that capital to re-expand. And, anecdotally, go to a restaurant. It's hard to get a reservation. It's hard to get in there. You get in there, the room's not filled, but they're at capacity, right? Yeah. And so I think that, maybe this is a hiccup there. And that's why I'm a bit concerned, because that's where we've seen the job growth as of late. So, I think the commodities are the way to play this for the time being. Look, after seeing a 6% rise in oil, maybe just look to see
maybe
something.
Not today.
Yeah, maybe not today, but still.
You know what else is interesting, Jeff? You raise a really good point on the fact that, so when money leaves the regional banking sector, a lot of it went to, systemically important banks. So now they've got a whole bunch of cash on their balance sheets. The challenge is they have no infrastructure to flow that back to loans in middle America to all those SMEs, small, medium-sized enterprises, SMEs. Yep. So in order to provide those loans, and this is what we're like, it's not like the cash disappeared. It wasn't like the 30s when 10,000 banks went under and everybody lost the money and the money was just gone. The money has been able to go to other instruments, whether they be those banks or to government guaranteed bonds. The challenge is there's no infrastructure for these banks to provide loans to these SMEs. And so we just keep, every time we go look for ways to channel finance back to the economy to get the growth to occur, we hit a wall, it seems.
Well, think about it. During the pandemic, the transmission mechanism when the free money programs came out, right? How did it go? It went to the banking system, right? And so that is a channel to get there. But look, it had to go through the GSIBs, as you said, because they're the ones plugged in. They had access to that. And so, to me, what you do here is that you just say, look, we're going to help these banks out for the time being, but also we're going to tighten the screws. Regulation's coming, right? And so, some people say, well, they got lax in the last administration when they laxed the GSIB status, or the route of regulation went from 50 billion deposits and they moved up to 250 billion. So it created some consolidation, right? Banking's a scale business, right? You're not going to do well in banks if you're on the corner just trying to lend money in the neighborhood, right? You've got to get scale. And so ultimately, I think what comes in this is regulation. And what that also means, that comes back to my basic tenet. It's cost of capital. Because if you have a higher restriction of what you can lend out, what you do is you want to make sure you get the return on that capital. It's not as much of a scale as it is bringing that, making sure you get, again, to cover what they call the risk-weighted capital charges, the risk-weighted asset charges. And so I think what you need to do is apply that down. And look, right now, it's like JP Morgan gets hit with like the highest capital charge because the highest base. Right. So there's got to be a way of having a sliding scale here and I'm not saying to make it more competitive with the national banks or the GSIBs as they're called. I think it's government systemically important
banks.
Yeah. We love acronyms, so we ought to use those. Right? Yeah. But ultimately, I think what you'll see here is that it's just going to be a regulation. And there's a reason you haven't heard anything out of Mary Dailie's mouth since this whole happened. Like, that bank is under her control. She is the San Francisco president of the San Francisco Fed. That is her job, is regulating that system. And so, she's trying to stay out of the limelight right now until they can figure it out. And yeah, there's an investigation under it. And look, it's going to be lax of oversight. And so I think what happens there is that you allow that transmission still to work. And if you think about it, it's kind of like the perverse thing, right? First Republic has to run its bank. It loses 30, 40 billion in deposits. It shows the big banks. JP Morgan lends a syndicate to lend it back to them, right? It's like, we don't want your money, right? But we'll help you out. And then, and what really made me nervous, a week or so ago was that when, JP Morgan said, no, that 30 billion, we're going to invest it in there. And First Republic stock went down, right? To me, when I see something like that, it's like, the market's like, wait a second, why are you trying to do this? You're going to absorb them. And I don't think there's any desire to consolidate from the large banks to take any of these banks together. And so, I was talking to a few folks in New York. We were out there talking to some bankers doing what we do. And, one of the guys I was having dinner with was like, look, if I'm in this middle scale bank, I merge with another kind of large middle scale, I get to GSIB status, and I know I'm in better shape, right? And I'm like, yeah, but unless regulation's coming, that's not necessarily good for your business. And so, and look, then we create the problem of we don't have enough competition, and that's where the regionals really do good. They do a great job of that.
Also, as we've talked about, they've got the pipes to the SMEs, right? The small medium enterprises, they have the structure. You can't. Well, you need a loan for your farm equipment business in Iowa,
right?
You think
and you don't have a
JP Morgan's doing?
You don't have the traditional credit line, so you don't have traditional income. That's where we saw it in the mortgage market, right? Where the Alt-A loans, because someone is self-employed, right? They're not in that same system that works for the big banks, right? Because it's automated, it's a law of large numbers. And so it's the personal relationship, right? And it's integral to this country. We have this large land mass, right? We're that we're spread out, and we have an economy that fires on different cylinders. And so it is extremely important there. And I think that's why, it's also very important to say these banks, and I know it's been politicized. It's like, well, it's Silicon Valley Bank. Of course, it was wokeness that did all this and everything. And give me a break. We're talking about the financial aspects of it. And it's like, it's going to be politicized. It's like, well, you save, a democratic state bank, because you're in charge. It's like, there's bigger issues here. And so I think when people realize that, it does make some sense, but it's also like, there's still bad actors in here. Look, they scaled up at the wrong time. They invested in what everybody else was buying at the time, and it's down in value.
And they didn't have a chief risk officer.
Well, if they did,
they didn't.
First of all, I don't think that person.
For 9 months, there was no chief risk officer for the previous 9 months. Now, I just want to pull on a string, Jeff.
I just wanted to
one thought. Hold on, Pierre. On the idea of allowing these banks to scale up and become sort of more oligopolistic, I kind of view that slightly differently. I think you want to have regulation that sort of makes the banking system a little bit more regional to attempt to have, some guardrails around having a fire. Like the one nice thing about Silicon Valley Bank was that it was tech oriented, and that area suffers the loss. But the farm equipment guy in Iowa, maybe he's not suffering that loss if you've got sort of a more regional type approach to banking. So I wonder if actually making these things bigger and bigger actually helps us.
I don't think it does. I don't think it does. That's what I was saying. I was kind of arguing with the guy that night, and he works for a GC. He works for a GSIB, and he said that week they got $37 billion in deposits that week. And so you can guess, which of the organizations he worked at. But I would argue that, at the end of this, it's like, no, that's what I was saying. I think what you need is the regulation needs to come down. Now I was going to say, regulation on a free market capitalist and everything. But we need the regulation, because notice what happened. None of the GSIBs had this problem, right? They also had their available for sale portfolio. They did what they needed to do in some of this. It's because they have a higher cost of capital through the risk-weighted asset charges and risk-weighted capital charges. And so that's where I'm saying you don't have to level the playing field, but you have to monitor it. Right. And that's where I say, that, JP Morgan doesn't want this business. They don't want to scale up, on that side, because they already have too much money today. right? They don't want it. That's why the deposit rate's a basis point. They do not want your money. They do not want it today. But I agree, we need access to this. That's why I say we have such a landmass. We have such a distinct economies across this country that, people don't understand that business. Ask the Midwestern banker what's going on in Silicon Valley and that client. They'll say, well, they deserved it. They're crazy. They're gunslingers. And, you're saying you want to lend to a farm. You want to give them $1 million in equipment loans and he makes $75,000 a year. Is that a good deal? So they don't understand the business, right? And so there is some, stuff that is very integral to that. So I'm actually agreeing with you, Mike. Gotcha. I was disagreeing with this person.
I got you. I got confused there.
I'm going to be invited to dinner again now.
And sorry, Pierre, I didn't mean to cut you off because I wanted to circle that drain.
I just wanted to ask about the Federal Home Loan Bank advances. To what extent? I mean, it's less than obvious. It's not like the other two facilities, the window and the BTFP, which are very sort of stigmatizing, very public means for the banks to shore up their books. But behind the scenes is this Federal Home Loan Bank advances that's happening. There's been some very large issuance the last couple of weeks. I think Alfonso Pecatiello pointed out that there was something like $300 billion in advances. Is that a more sort of quiet way of shoring things up that's going on, or is that off the mark?
But that's what the FHLB is for. It's to help kind of bring stability to that and ensure deposits. And so essentially, that's kind of how the FDIC operates, is through that mechanism, to my understanding. And so, using that, I mean, look, you can buy FHLB bonds today, right? That's what, right. They issue bonds to help that funding as well. And the spreads haven't blown out. We looked at them because they're government guaranteed, right? So there's something to look at when there's a crisis like this. But, ultimately the home loan bank is there to provide that liquidity, and it's not the same kind of stringency that you see at parking money at the Fed, right? Certain asset types are eligible and the like. So, this BTFP program, I think, no one wants to use it today because if you're known, it's like during the financial crisis that, when they rescued the banking system, they gave every bank money, right? Because they didn't want you to know who needed it the most. Yeah. Right. And some people are like, oh, well, we don't want it. It's like, no, you're taking it. Right.
It's like the firing squad. Yeah. It's like the old fashioned firing squad where only one rifleman had the bullet.
Right. And everybody shoots to make sure that no one knows who did it. And then you don't have the guilt either. Right. But I would say that, I don't read too much into it. I view it all as one thing. At the end of the day, the one word that sums this up is liquidity. The bank didn't have liquidity. They needed it. The system was deficient in that. Instead of creating this fear, because once you hear about a bank going down, the next thing that happens is everyone starts to question, is my bank next? And should I go do this? And I still think it's, I won't say funny, but I find it very interesting in 2023 of people staying outside of a bank to try to get their money. Look, you could do it electronically. Like everything I heard from First Republic clients was that they were able to wire money out instantly, right? There was no issue wiring that day and the like. So it's like, have you ever went to a bank and tried to get $5,000, $10,000? They don't want to give it to you, right? Because you're always doing something unscrupulous if you're doing that. And so, it's fine. It's pretty interesting to me that anyone who's in line, the amount of cash they're going to get is under the FDIC limit, right? Do you think you're going to go in and walk out with $1 million in cash? It's just not going to happen. So that's where I found it kind of, I'm like, that's a fear mongering kind of concept though too. So I just don't read too much into FHLB. I think it's all just liquidity. And the thing is short up to shore confidence up. But now the next thing comes is like, how do those banks protect their deposits? And we've still seen an outflow of the banks from what we get in the reporting. There was a new outflow of of the small regional banks, and the large banks got more money in, right? And so you're seeing that transference happen. And a lot of you are waking up. But did you guys see this announcement that there's a new VC or tech company that it's going to help people invest in treasury bills? Right, they're going to help manage your liquidity. There was like a $20 million valuation or raise on that, and I'm like, again, Treasury Direct, man. Like, look, I'm not trying to compete with the Treasury here. We're actively managing bond strategies, right? I don't care if you want to buy T-bills. I've heard it from clients for the last year. Like, I want to own this. And it's like, look, I don't have a problem with you doing that. But when you own T-bills, you have reinvestment risk. When it matures, you have to do something. So you got to think about what that means for you. But ultimately, if your cash was earning basis points, look, it's shame on you, right? For not knowing that. But also, that's part of our job. That's why we're doing this podcast, right? Is to try to make people aware of things out there and understand that the system only works for you if you know how to play in the system. And, a lot of it is just understanding, the tools you have available. And most people don't realize it, that you could go buy, a government money market fund, or you can go buy T-bills direct, and they massively outstrip what you're getting paid to park cash somewhere. And you get seduced by a CD. Like, you see, I remember walking down Manhattan and seeing First Republic advertising a 2% CD. And I'm like, why would I lock money up for 12 months when I can buy the 12-month bill and it yields like 480 at the time, right? So anyway, I think I think a lot of it is just understanding this. And I just don't think we're done yet with seeing some of this movement of cash because people have woken up to it.
Yeah, I think the other strange thing is that there's nothing wrong with the assets that we're talking about. Right? That's the other thing. There's absolutely nothing wrong. They're doing exactly what was expected. If rates were going up, they were going down.
Yeah. You want to fire sell those assets, you want to sell them at a distressed level, we've got a bid. Yeah. We've got a massive bid for that because they are money good. They have mark-to-market risk. They have duration risk, but they will mature at par. And, that's the thing you could not say during the financial crisis. And that's the distinction here, is during the financial crisis, no one knew what those assets were worth. Right? We all had guesses. You have to run a model to figure out what it is because you own the credit risk. These are money good assets. They are insured by, or they're backed by the U.S. government, right? And so that's the biggest thing about it. It's like, so does someone want to step in and buy it because you can buy these assets? Well, it's like, no. Do I want the liability of owning a bank? No, I'll take your assets if you want to sell them below market, right? But I can go buy those assets in the market today from someone else at market price. So why am I incentivized to do that? By the way, I don't know your loan book, right? I don't understand that. And so unless they do, it's going to be very difficult for a sale. And I think, I'm glad to see there's been some stability there, but I think we're going to get another dose of this at some point. And I'm not saying we're going to have more failures. I think it's just going to be, someone's going to lose a lot of deposits and something's going to have to happen.
Yeah. Absolutely. I got a question. Yeah. I want to change gears just for a moment as well, because I want to ask you about this rotation that's taken place in equities, because it seems to me like the high duration stocks, technology, crypto have rallied massively in the last quarter. Yeah. And I love it when I hear the crypto song, happening, which is the digital gold song. Yep. And crypto C, we told you, this is the problem. There's no interference here from a central bank, and that's why people are flocking back to crypto and risky high duration assets. What are your thoughts on that rotation? Is that a mistake? Is it something that's fleeting, or is there something real, some real fundamental action going on there?
Yeah, I think if you go back to academic research, it actually shows that a lot of the technology isn't interest rate sensitive area. We've crafted this narrative in the last cycle, and I think what it is that growth was at a premium, right? When there's low growth, if you get growth, you'll pay a higher multiple for growth, and so does interest rates really influence that? Look, reference Cliff Asness, look at his take on it. He's way smarter than I am. He's written on value and growth forever, and it is a misconception. And I think this last rally to me feels like it's like, oh, rates are down, of course tech is up, right? You turn on the TV, you look at media punditry, everyone says that, right? And so I think it's kind of in the cycle, like, yeah, of course, if rates go down, tech should go up. Well, if we have a VC problem, should tech go up? Right? I mean, it doesn't make a lot of sense to me, so.
Well, it was the very, very big tech that's gone up.
It's the five names, and they were beaten up a bit, and and I don't know.
They're
I don't
calling
know.
them
Is it-
Nana now.
I got a bit of a thesis on that, but I want you guys to.
Okay,
beat
I'll
this
let
to
you.
death
I'd
first,
love to
and then-
hear it. I'd love to hear it too
Like,
because
is this short-lived? Is this a
I
short-lived?
feel it is. I mean, look, the multiple's expensive on those 5 names. They drove
Yeah.
the stock market again. They drove the Nasdaq 100. If you look at the equally weighted tech index, a lot of people. I was watching TV this morning. I don't know why I was watching CBC, but watching it, and someone said on there, well, tech and all this. But if you look at the equally weighted S&P, I'm like, why don't you use the equally weighted tech basket? You're talking about these 5 names. Like, there is something out there. You can look at it. And it's like, use that. Like, it's the same argument, but my point is that it's not this robust, deep rally. And so I feel like there's this
Yeah,
new
the breath
narrative.
is awful, right?
Yeah, the breath is awful. Just like going to the garlic restaurant over there in Melrose. I can't remember, the Stinking Rose, I think it's called, right? Stinky breath. But point being is that I do think that in the psyche, it's like, oh, rates are down, it's going to be supportive. This is what helped tech before. It's kind of baked out there right now in the psyche, and like this was a whole different issue, And so I'm not convinced that there's the sustainability in that. The crypto side is interesting because if you want to tell me it's the digital gold, right? Last time gold traded 2,000, where was Bitcoin? It was near the 50,000 handle or whatever. So I don't know. Your story doesn't kind of hold a lot of water there with me. But you know what? Look, this is the crisis of confidence. If you think the banking system's failing, this is again crypto's moment to shine. And it's up. Okay, great. It's up on people putting money into it, but does it move anywhere? Right? And that's the thing. In order to drive the price up, people have to buy more, right? That's how markets work. It's not a cash flowing asset. So again, you look at it, I don't know what to make of it. I feel like looking at charts, crypto is best described by the Qs, the Nasdaq 100. You watch the Nasdaq, you watch crypto, they move in tandem, right? Maybe crypto's a little levered to that bet. It's essentially what the bet looks like to me. So putting those two things together, Pierre, I think that's kind of part of the crypto. And look, if this was digital gold, I want my money out of the system, we're all gonna buy it. It would have done multiples of what it did.
Yeah.
So on the tech side, there's a couple of things that are kind of stirring around my brain. One is when you contemplate inflation, one of the best inflation hedges is to have something where the cost of production is very low and prices can be raised very easily, which are subscription services. Subscription services in particular for software. So these can provide some very interesting inflation hedges. And layered on top of that, the one thing that's changed since November is ChatGPT and AI. Today, as we record this, the 3rd of April, is the 50th anniversary of the first cell phone call. Strangely enough, came across this. It took 16 years for the cell phone to reach a user base of 100 million people globally. It took ChatGPT 2 months.
Mm-hmm.
We're talking about the square of Moore's law. Mm-hmm. And it's funny that it's the 5
Who just
majors.
passed away, by the way. Moore just passed
did
away.
he? Well,
Yeah.
and so
Yeah.
we just keep layering on the mystery here. So it's the one thing that I kind of think it's overdone, just sort of like you. I'm like, it feels like, but then I'm like, God, ChatGPT is revolutionary. AI, Midjourney, these places where you're able to increase your productivity almost exponentially as an individual, changing the landscape not only for the computer programmers, but for the creatives. If you haven't checked out, Midjourney and whatnot,
Mm-hmm.
I wonder if the market is anticipating the types of potential earnings flow that is going to come, and it's going to accrue largely to those 5, like Microsoft's building it into Office. It's in Google everywhere. It's pervasive, and it's largely centered around that. And then you look at the chips and the semiconductors. Well, that's what's required. You use high-end chips. All of a sudden, you see performance in that area too.
Like NVIDIA is one of the best
Yeah,
performing stocks in
NVIDIA.
the quarter, right? Yeah.
Correct,
Yeah.
because that their graphics chips are what is used largely for the data interpolation for the AI. So I look at these two factors, one of inflation and sort of this idea of low input, good cost flexibility, and then the explosion. I mean, we're over 100 million users in 2 months. That is mind blowing. And then how that might relate to, the crypto world and the Internet of Things. Like, we get a little bit into being a bit of a futurist here, sort of just thinking outside the box a little bit. But I got to look at the price, and I got to look at crypto, Silvergate out, Signature done, SVB gone. Those were the rails to the traditional finance system, and crypto seems unfettered. I mean, I don't know. I literally don't know here. I'm just sort of speculating in my mind about, wow, we've had some pretty interesting things launched, this whole AI, its impact, its efficacy. And I think there might be something there. That would be something that wasn't in the equilibrium sort of in 2021 and early part of 2022. So I just leave that as
it's free. It's free. It's not like when the iPhone came along and
I think ChatGPT is $20 a month. I pay for an upgraded service, but 100 million people jumping in and immediately.
Yeah.
Yeah, look, I don't really know how to interpret the ChatGPT thing and what it looks like. To me, it's just, it is the neural network we've been promised for 30 years, right? That it's going to learn on the fly, it's going to do it. And so, look, it seems interesting. Is it a fad or not? I don't know. And, look, maybe that is part of it. And, kudos to Microsoft and stuff for the subscription-based service, because who the hell wants to buy another disc or download the latest version? You force it on people, right? I mean, it was brilliant, and so, I think you're right. And, especially with automatic payments, which, by the way, still go to the financial system. People forget, especially like the best subscription is the annual, because you forget about it. If it's the monthly and you look at your statement, you may miss that one charge too. But I mean, it's an interesting thesis, and I guess we'll see.
It's music, it's movies, it's all of that genre of, like we have a music library. I don't know what movie's going to recreate some song from 20 years ago and it's going to get hot again. And I have songs now on 18 different formats in 6 different subscription services. I'm like, man, oh man.
No, it's funny because, and then when like a TV show or one of those, cultural phenomena hit, and all of a sudden there's this song and it goes like viral, right? And there was one that recently, I can't remember what it was. Yeah, exactly.
Kate Bush one with
it was like for 30 years she would just leave the series. She's popular outside the U.S., right? Yeah. And then all of a sudden, it was on. I don't even know what show it was on, but it came out, and then she's like a #1 hit, and it's like, wow, that she was playing the long game, man.
Oh yeah. She was running up that hill.
Running up that hill, yeah. Stranger Things.
That's long duration.
Stranger
so.
Things. Yeah.
All right, fellas. Well, hey, I need to hop soon, so let's take one more topic and let's beat it to death, and then we'll call it a day if that's good for you.
What do you think of just diving into Credit Suisse and the AT1s? Because that was really unique how they zeroed the 16 billion in AT1s, shored up the senior notes, gave the equity holders. I don't know if you want to dive into that a little bit, if you've got some talking points on that.
Look, we never liked the risk. I mean, they were bail-in bonds. They weren't bailout bonds. You were the one bailing people out. And look, this is what they were meant for, is to help shore up the system when something bad happens. So we never liked the risk. We've been worried about Credit Suisse for a long time. There's a couple other banks on our list that we've been worried about for a long time. And look, our trading budgets have diminished with them. We have risk management, we have counterparty risk committees, and their job is to analyze who we're trading with. And a lot of people don't appreciate that, the work that goes into that, because you think, hey, I do a trade, well, it's done, right? We get a price, you're getting it. We have settlement risk, right? We trade bank loans, right? Those sometimes don't settle for like 7 to 10 days. In that period, you own counterparty risk, even though you've traded a physical security. And so, I think at the end of the day, it's just important. And, look, Credit Suisse didn't like us for a while as we were doing some of this because, we went down in their league tables massively. And, we get calls and it's like, I don't know. I don't shock about it. You got to improve the price, And so at the end of the day, I think, it's looking at the stability of this. And like the European banks have been in shambles for a while. And, we're trying to always figure out with like a Credit Suisse, like, even if the SMB steps in, can they? What are they going to do? Right? What are they going to back it with? They lost all their gold, but they make chocolate. I guess people still like watches. And so it's like, and again, I always give the Swiss crap because it's so expensive to ever go there. I'm always like, how do you guys still survive here? But ultimately, a lot of people have like reckoned this to Deutsche Bank now. Deutsche Bank has been a concern with us off and on over the years, and the one thing about Deutsche Bank is the Bundesbank is not letting them go down. They may nationalize it, they may do some, but like that's something that it's probably going to work. It's just like the U.S. system will bail out our American banks, So
it's a substantially larger economy backing that particular bank.
One that has a lot of trade relations. There's a lot going on. They're not predicated on hiding money around the world. Again, sorry to the Swiss out there. Privacy. And look, they never recovered in the crisis. And I still would argue that part of it was they tried to say, we're not going to deal with your U.S. privacy laws. And we said, come to America and you're going to jail. Right? And we seized on that. That really hurt the Swiss banking system, right? The U.S. did try, and it was a long time coming, but some of it is because of what happened in that kind of, mid 2010 era, right? And so I think that, look, these banks are super complex. We have GSIBs. They're no one understands every risk inside that bank. But you watch share price, you watch the CDS to protect the bonds, right? The credit default swap market on it. You look at the markets looking at it, and when you see something plummeting time in and time out, it's hard to get excited about wanting to do business with them if you can do business elsewhere. And look, as much as I've, lauded First Republic as being this great bank, I don't want to do a transaction with them right now, right? Well, why would I? Right? I have many other options. And so I think that's part of it. And, look, the market can take you out of business, right? And, that's part of what happened here. And I think, their problems had nothing to do with the SVB issue. Credit Suisse have been spinning off arms of their business. They spun off the profitable stuff. They keep selling stuff in the market. And I think the market just finally said, look, if there's going to be a next shoe to drop, it's Credit Suisse in a big way. And it punished them. And that's why the SMB had to step in. So, that's not like, I don't think they're related. But, there is some kind of knock-on effect there just because we had this banking thing in the U.S. And, so I think what it should do is alert your antenna, or it should raise your antenna. It should alert you a little bit to say, what are unintended risks that I'm taking? And, it's not unidentifiable, but, what happens here? And to see that, my wife has an account like at, she grew up in Texas, this small little like credit union there. They sent her a notice about they had no exposure to Silicon Valley Bank. I was like, they don't even know who it is. Like the person that wrote this letter is like, oh, we got to just tell all our clients we don't have any exposure. And it's so funny. It was like during COVID, right? The barbershop gives you their COVID policy, going, and it's like, what? I'm not concerned about the barbershop's COVID policy, right? So, again, I don't think they're completely related. Yeah, there probably was something in there, but that bank was heading for trouble for a long time.
Well, I think they're related from a global perspective of a very quick and fast-paced series of tightenings globally.
Yeah.
And the tide's rolling out, and we're going to see some naked swimmers.
Yeah, and I've always liked that metaphor, and I think that's what's happening here, and you're going to realize through these cycles is that who's actually managing risk, and when you don't have a chief risk officer for a while. Not usually a good sign. It's like, our company's completely profitable, but our CFO's resigning. Look, the thing that kind of screwed First Republic is they put out a notice to all their clients that we're fine, we're solvent, everything's good. I'm like, well, they're bankrupt by Monday. Happens, right? When you doom. Right, it's the letter of doom. So, look, I think what it is just, make sure you understand as much as you can about who you're doing business with, how you're doing it. Understand the safeguards you can take. Risk-free money should be in risk-free things, right? There's no free lunch. Lending out your crypto, it's not risk-free. All these things out there, and so I think that you're going to see that. But also, if we continue to see deposits flow and more money go into money market, that's money that's not going into the capital markets either, right? And so you can say it was cash on the sidelines. You're going to get some equity analyst reports going to say, look at all the cash on the sidelines, all this money in government money market. Well, it was sitting at the bank anyway. It's rainy day funds. It's people using for savings. And I just think that that's another sucking sound out of the capital markets, which makes things tighter, right? And so ultimately, this is why, I was pretty optimistic that we could make it through the most of this year and maybe stay off a recession. Maybe we skirt along a little bit. I never believe in the no landing scenario. I mean, eventually things run out of fuel, that we will land at some point. And ultimately, it just feels like things get pulled forward. And is it soft? Is it hard? I don't know. But I do know that it depends on our response mechanism to it. And if things play out as a typical cycle, we have some form of recession, and all of a sudden we need to throw stimulus at it. Well, then comes the next round of inflation, Mike, back to your point on the inflation side. So we may get a little disinflation. I noticed Jay didn't use anything about disinflation the last one. And you mentioned something earlier that he addressed the credit contraction. I give him kudos for that, because most people aren't going to really understand that at the surface. And him going, I guess most people don't listen to Jay Powell like the rest of us do. But I do think he's trying to address these things. And so that's why I think the Fed should be done with the rate policy. Let's just see what happens for a few months. Maybe that, I don't think they need to cut at this point, and I don't think they do cut until something really bad happens. And they have to see it. They don't think what they're doing is working. And at that point, there's no we're going to take off 25 basis points this month, and in 6 weeks, we're going to do another 25. They're coming in 200, right? It's going to be, they're going to do something that has an impact.
Yeah.
And so,
slowly at first, and then all of a sudden.
The old, is that Great Gatsby or no? It's Hemingway. No, it's not. Anyway,
Slowly, and then all of a sudden.
It's one of those classics out there too. But
Yeah.
anyway, so I just say that, I think these are lessons to folks out there. Don't expect people to bail you out again. Is this a bailout? It kind of is. But, look, what it is, if it is a true bailout, the cost of FDIC insurance is going up, right? Which means regulation's going up. And look, I'm kind of for it. I'm not for the cost of FDIC going up, but I'm for the regulation here. It's look, by not doing it, we caused a problem, right? So there needs to be a level of scrutiny at this size, and maybe a little bit smaller. But look, the local credit union that's got, 10 million in deposits, I don't know, let them figure out how they're going to lend in their little local community of 4,000 people, right? But when you get to a certain scale, it has impact, right? And so I think that's probably going to be the postmortem on this. And someone's got to take the blame on it, at the Fed, and it's their responsibility. They regulate the banking system.
Great place to leave it, I guess.
Yeah. Jeffrey, thank you so much. That was an amazing discussion. Thank you very much for your incredibly valuable time.
Yes, absolutely. And I looked it up. It is Hemingway. The sun also rises. And so if your listeners have not read that, great Hemingway book.
Thank you.
Love it. Oh, you want to just where people can find you, Jeffrey? I'm sure they can find you.
Yeah.
You just give them the last bit there. And
Search everywhere for this painting and you'll find it, or this photograph and you'll find me. The best, obviously DoubleLine.com. We have our podcast out there, the Sherman Show. It's on all the major podcast providers. We have a Twitter account at Sherman Show Pod. I'm trying to use it a little bit more to put up stuff just besides the podcast. It just, my time gets kind of sucked away in things, and with compliance, I think it's just a little bit of time. But that said, reach out to us too. You want to be on the Sherman Show, you got a great guest, got a great recommendation. I'm always lobbying for new folks to come on there. So I have an email address, shermanshow@doubleline.com. So thanks for listening. Thanks, guys, for having me. It's a pleasure. It's great to see you again. And, best of luck as we start the second quarter here.